I agree with you. I think it's very difficult to expect a bazooka. Like I think it's funny, right? It's been 18 months of downside in the real estate market, and with big construction companies getting in trouble, a big push into savings by households, and we know this is a super important sector in the Chinese economy, and we haven't had any bazooka-like reaction by the government. I think this is the crux of the issue here, right? It's over the past 10 years, we developed the sense that the Chinese government can steer the economy into prosperity and even rebalance the economy. Remember, they've been rebalancing. They've been focusing a lot more on personal consumption, but I think that we have to revise this assumption now. I mean, the Chinese economy will be still struggling with many headwinds when it comes to growth. I saw the picture there with all sorts of GDP forecasts. It's not about the forecast itself. It's about the government's impetus and the wording around this 5%, the potential 5% growth target, right? There will be a lot of scrutiny when it comes to the fiscal gap. I think that tomorrow's statements will be probably more important than today's. A lot of scrutiny in terms of the fiscal targets, right? I mean, we know that the fiscal is probably the number one lever, but it's still very troubled waters for the Chinese economy.
I was debating yesterday whether you would lose out on China if you invested today, if you had a long-term play.
What were you doing yesterday?
Walking around contemplating, world indices and where, you see value at this point.
Yesterday, don't you? It's a day of rest.
Meant to be, but I was just thinking about it.
Wow.
Obviously at this point it looks challenging. There's been a little bit of a sign of life thanks to Team China on the stock market this year. But if you were looking out, say, on a 20-year horizon, would you be okay with that investment today that there's going to be a rebound? Or is everything we're talking about around this playbook, China playbook being broken, potentially even damaging for a long-term investment of, say, 20 years?
I think it's very difficult. I mean, we've written extensively about that. It feels like you've said national team and the impact on equities, right? It's great. If you look at the inflows, amazing. But aren't they treating the effects of the disease rather than the source of the disease? I mean, we ask ourselves this question, right? I mean, as a Chinese market capitalization reached a peak in 2021. Since then, we have come down by $7 trillion. This is 30 to 35% drop. In the same period, other EMs, I'm gonna cheat here. I'm gonna use India because it was a massive move. India market capitalization has gone up by 60%. US, 15 to 20%. So, I mean, something structural happened there, and it's very difficult to fix.
So here's the question. If you want to put money in EM at the moment, it seems very clear from the FDI and from the flows more generally that people just are still cautious and they want to see more evidence of recovery in China. So they're not putting it in China. So are they putting it in the same old suspects, i.e. Mexico's of this world, the Vietnams of this world, or actually is there a more nuanced, subtle trade out there for our viewers?
There are nuances, Steve. I mean, in the sense that, we actually believe that EM credit, so the dollar bonds in EM, they're actually going to, and the high-yielding dollar bonds, they're actually going to do a lot better over the next quarter, right? Let's not forget, the easing cycle for EM central banks is very mature now. Right? Brazil has been cutting rates for a long, long time. Mexico probably, is starting now. But, in Central Europe, the Hungarians, the Czechs, they have been cutting for quite some time. So a lot has already happened in terms of easing cycle. So, the cycle is mature now. And on the other side, the M credit, which we know up until last year, many of these high-yielding issuers, they had no access to the market, and little by little, they are gaining access now. And spreads are still, pretty chunky. So we are talking about 400, 500, 600 basis points over Treasury. So we do like the M credit space rather than local. So it's a lot more nuance. There can be a lot of rotation in M portfolios going forward.
But one of our headlines today is there is a gentleman in the United States from, I think it's Apollo Asset Management, who believes actually the Fed might not even be able to cut at all this year. Now, I know that's an outlier, but I understand where that gentleman's coming from when he's looking at the inflation data as we currently see it. If the dollar remains stronger and interest rates still augur more flows into the US currency, what does that mean for the US dollar-denominated debt in emerging markets as well. Surely that's going to put a bit of pressure on those.
There is a dichotomy here, right? Because, the fact that, okay, if the US economy is so resilient, that's great. Fed will have, a much narrower space to cut as we go into the summer. And we're still in a call of June. This is good for US high yield. This is good for equities, obviously, for the credit part of developed world, right? It means that we're definitely not heading into a recession anytime soon. So that, in a way, reflects positively to EM credit. It means that the cycle for EM credits is still all right. You have a very interesting point when it comes to the dollar, right? And if you go around, many investors out there, they still have the assumption that the dollar will be easy, right? And in EM FX will perform really well versus the dollar. And I think that's the trick here. So I think EM FX or allocations in MFX will be a lot trickier as we go into the summer, because the question mark is the Fed really going to release the easing cycle by the summer or not? It's still a very resilient economy, if compared to Europe especially.